Hey, what's up? It's Rick Dykes with Covenant. Hope you guys are well. Last week, I hit you with a video um, that was about, let's get out of this whole mentality of like just doing what everyone else is doing what we're told with our money, and just riding those ups and downs of the market. And this week, I want to talk to you about like what else could you do? What else is out there? And I came across this article, and I've seen this in a lot of other places. I've heard these stories, but a lot of people don't realize that over the years, like for many, many years, decades, going back 100 years or longer even, that people, like famous entrepreneurs, have used whole life insurance policies that they own on themselves. They've borrowed against those. They've taken money out, and you borrow against it, by the way, because you're borrowing your own death benefit. So, like when I own a life insurance policy that has cash value, it's whole life insurance. It's permanent, and statistically speaking, it's factually true. Like 1 out of 1 people do die. There have been very few instances where someone didn't die. So, that's going to happen. And so they take money out against their own death benefit, which death benefits in life insurance are tax free. So if you borrow that death benefit, it's a tax free distribution. That's why you take a loan. So they're borrowing their death benefit. These famous entrepreneurs who you would know their businesses, they take money out, and because as a tax-free distribution, they don't have to apply for credit. It's their own money. They're accessing it easily. They're able to either start or save their business, whatever the case may be. So some of these stories that I've known, I was just looking up like, hey, what's the full story? What about it? So I was going to tell you about a couple of those, because maybe you've heard about like life insurance and how it works, and you're like, well, who's really doing that? And so I thought I would just kind of throw out a couple of names, so that you would know, and that you would know that like this is not some new thing or new age thing. And maybe it would just help you think a little bit, because last week was all about hopefully inspiring and encouraging you to begin to just, believe in yourself as your best investment. And I hope that helps you, because I do believe you're your own best investment. And so this week, I want you to know that like there have been a few people who have gone before you who have done this. So first of all, there's an example of Walt Disney, who was, I don't know if you guys know this, but Walt Disney was born in 1901. Like that goes way back, and founded Walt Disney Disney in 1923. And actually, people know, like people think that his first big character was Mickey Mouse, and it really was his first most famous character. But there was a different character that he had created that someone who was a mentor and had worked with him kind of stole from him. That's why in the movie Saving Mr. Banks, he's so sensitive to the creator of Mary Poppins' reluctance to give over that character. And he says to one of his colleagues in the movie, he says like, this would be like someone trying to take away the mouse. He references that because something like that had happened to him. So he references that. But there was a time when he wanted to create Disneyland, at a time where like theme parks were basically garbage. He wanted to create this excellent thing. He actually used his life insurance policies, personal life insurance policies, for financing for some of the seed money, because no one really had a vision for what a place like Disneyland would look like. There was a Six Flags a mile and after, which like Disneyland is a whole different look from Six Flags, obviously. But there was no way to paint that vision for banks to understand that. So he needed money to do it, and he didn't. The Disney thing didn't exist quite yet. So he got the money from his life insurance policy, because he was just able to get it out. It was cash value that he had built up. It was a place that was, he had been able to save money in it. It was earning dividends and interest and growing like crazy. So he pulled money out, and we have Disneyland and the Disney name, and really a big part of what Disney is today because of cash value whole life insurance, from mutual companies that were paying him dividends. So that's one great example. Another company, a lot of people know the story of Ray Kroc and how he got involved with the McDonald's brothers, to begin to take it national and franchise it. Of course, they created the system that was the McDonald's, thing, but he took it national and franchised it. Where early on, it wasn't a cash king, like, and he was really growing at a fast pace. Like as soon as one would get going, like he would go start another one. There's a movie about that several years ago, which was really, really good. If you like stories of great business owners, great business people, kind of pioneers in business. But early on, he was needing financing to go from one franchise location to the next. and wasn't able to get it as fast as he needed it, took money from his own personal whole life insurance policies to keep key people paid, franchisees paid where needed. He used his own personal future death benefits. He borrowed against them so that it would be tax-free distributions on his policies. And McDonald's is in part what it is today because of whole life insurance. So it's another example. So Disney, McDonald's, two pretty good examples. So those are business examples. And here's another one for you. During the Great Depression, James Cash Penney, we know that the store is J.C. Penney, in 1898 was working for a place called Golden Rule Store. I didn't know that's where he came up, and he became a third owner in a new set of stores that these other two owners were going to help start. And when the other two owners pulled out, he became the primary owner. He bought them out, and that became J.C. Penney. Well, J.C. Penney grew a lot, and then in the Great Depression, obviously the stores were struggling, and he was really having a hard time with it. And in order to keep the company going and to keep the right employees in place, J.C. Penney took money from his own personal policies to keep J.C. Penney afloat, and then actually stayed on with the store until he passed away in 1971. He stayed on and was involved, and actually he was honorary chairman until 1971. And stayed on until 1946 as chairman of the board. So he actually floated it all the way through the Great Depression because of his personal whole life insurance policies. So that's another example. And then one last one, which I thought was really cool. I did not know this one at all, but Stanford University was founded in 1868. And it was funded through a very, very difficult time around 1893 through the cash value in a whole life insurance policy. It had reached a point where they didn't know if it was going to make it, and they used their personal, the founder and the founder's wife used their personal whole life insurance policies to get it through. So I'm giving you these as examples so that you know that it is a viable way to hold and use money. That's what makes it so interesting, is that a lot of these things, that traditional financial planning tools, are more long-term vehicles. Life insurance kind of gives you the best of both worlds. It's not necessarily competing on rate of return. It's not promising these 8, 10, 12% rates of returns. It's slow and steady Eddie on the rate of return. But what was Walt Disney's rate of return on creating Disney World? Like, what was that rate of return? Because the money that came out of whole life insurance, by the way, continued to earn dividends if it was a non-direct recognition company. That's something that we'll talk about in detail probably in another video. But you take money out and it continues to earn the money that's in the policy while he used it. I wonder what his rate of return was on Disney World. Probably pretty good because it's still kicking today. And by the way, my family and I, as you watch this video, we're getting back from a trip through Orlando. We spent a day in Disney World on the way back. And I'm sure everything was expensive and awesome. And so I'm sure Disney World has done okay as far as rate of return went. And what's interesting is Mr. Disney, like, he earned his dividend and interest on the money, and he earned his rate of return on opening Disney World. That's what makes it so awesome, is you get lifetime uninterrupted compounding interest, which is a powerful thing in and of itself, and the ability to control and use your money to invest in things that you are good at, like Disney, like Ray Kroc, like the Stanfords, and like Mr. Penney. So I believe in you guys. I want to put you in control of your money. I think that this is just a great way for you to understand that this is not something new, flashy, fancy, something that you should be kind of like, you should understand this is something that famous entrepreneurs have been using forever. Banks, corporations own it, and people have been using for a long time to do great things with. So we'll talk more about it. Hope these videos have been helpful for you. If you will, subscribe to our video page on YouTube, and I'll be keeping on informing you through these videos, and hope you're enjoying them, and we will talk to you next week.